So right now we're going to dive into a simple, quick, high-level futures masterclass, and I'm going to break everything down that is the absolute most important, right? If you know anything about me, I like to keep things simple. I like to keep things effective. I can take something that's looked at as complex and I can break it down so an eighth grader can understand it. So if you're expecting a lot of jargon, technical fluff, a lot of complex terms and terminology, it's not going to happen. I am literally going to simplify this down to where an eighth grader could understand what we're talking about today. And I want to just give you the most important things, that high level overview, to get right to the point, to get you guys up and running with futures 10 times faster than trying to figure it out on your own, watching all these lessons and videos on YouTube, and still struggling with, how do I get started? What's a futures contract? What platforms do I set myself up with? What's a prop firm? How do I get set up with a prop firm in the first place? What kind of strategies are really effective and simple to learn to trade futures? So again, 30,000 foot, high level overview, no fluff, no jargon, no BS, super simple to where an eighth grader can understand this to get you up and running 10 times faster. And then after this, we'll follow up with a nice little Q&A session, answer any questions you guys have, and make sure you guys are all set. All right, so let's just go ahead and dive right into it. And we're going to talk about really futures versus options to start. Okay, so a couple key takeaways. Futures, simply it's a contract to buy or sell something at a set price on a future date. That's what a future is. And then an option is a contract that gives you the option, right, to buy or sell, but you don't have to. That's like the main big difference between futures contracts and options contracts. But let's simplify it even more. What's the main difference? Futures are more simple, right? There's no time decay. There's no extra factors. You don't have to worry about delta, implied volatility. You don't have to worry about spread between the bid and the ask. It's a one-to-one. So it's just 10 times more simple trading futures contracts than trading options contracts. Because what do you have with options contracts? You have time decay. Those contracts will lose value over time. You're going to see things like implied volatility crushes, where the IV could be high and then drop back down, which kills the cost and will lower the premium. That works against you. You have to learn about the Greeks, right? The delta, the theta, the gamma, the vega. There's just a lot more complexities to trading options contracts than futures contracts. It's simple. You get in, the thing goes up a point, you make X amount of dollars. That's it. No theta, no delta, no big spreads or anything like that. It's just 10 times more simple. So why futures for day trading? I love trading futures intraday. Not really swing trading. Swing trading is better for options and shares in my opinion, but like scalping intraday day trades, like futures 10 times better in my opinion. They're easier to manage and they're more consistent, and you don't have to worry about time running out. Can't tell you how many horror stories I've heard over my 10 years of trading about a trader that took a 0 DTE option contract, right? They made a mistake. They didn't sell their position and the contract expired worthless. They come in with risk of like $100 on the trade, right? But then it expires worthless and they lose their entire investment. And they're like, I just lost $2,000, right? Because that contract will expire. You don't have to worry about that with futures, right? So that's just a high level, quick overview regarding futures versus options. Simple stuff. Now let's talk about like futures tickers and then dive into some like risk reward per point with futures. So a couple key takeaways. Futures tickers represents different markets. For example, the S&P 500, the NASDAQ, crude oil, gold, silver, commodities, agriculture. There's so many different things that you can trade futures on, but we're going to talk about the most important ones, not even the most important ones, but the ones that you'll probably start trading in the beginning, the ones that are liquid, the ones that have tight spreads, the ones that are the most popular at the end of the day, right? The most popular ones are like ES, NQ, people trade crude oil futures, gold futures, silver futures. Those are the most popular ones, but there's so much more you can trade in the futures market. You could trade wheat, you could trade soybeans, right? But we're going to talk about the most important ones. And each ticker, right, has a set value per point that it moves. And when we talk about per point, we're talking about every dollar it moves. I don't like to look at it in the form of ticks, right? I like to look at it in the form of a point or a dollar just to, again, simplify it. So these are like the main tickers to know. You have ES, which is the S&P 500 futures contract. Every point that ES moves, your P&L is going to fluctuate by $50 for every contract that you have. If you trade MES, which is the micro S&P 500 futures, it's only going to be $5 per point that it moves. If you get in with one contract and it moves a point up, you make $5. If it goes a point against you, you're down $5. So it's 1/10 of the size. And that's what you're going to notice. It's about 1/10 of the size. Then you have NQ, which is the NASDAQ futures. So for every point that NQ moves, for every one contract you have, it's $20 per point. Okay. MNQ is the micro NASDAQ futures, and it's 1/10 of the size. So it's $2 per point. So one contract, it goes up a point, you're going to make $2. It goes down a point, you're going to lose $2, right? So that's how it is. It's a simple 1-to-1. Okay. Then you have crude oil futures, which is ticker CL, right? That's $10 per point for every contract you have. Then you have micro crude oil futures, which is MCL. That's going to be $1 per point. And you can go into like gold futures, for example. Gold futures, that's ticker GC. That's going to be $10 per point. And then you also have the micro, which is MGC, right? And that's $1 per point. So you see that the micros are 1/10 of the normal contract. So like ES, that's the normal E-mini contract. It's $50. If you go to a micro, it's 1/10 the size. Same thing with NQ. If you go to a micro, it's 1/10 the size. And it really follows suit with the main ones that you're going to be looking to trade. Why is that important? Well, if you want to start trading in the beginning with, say, smaller amounts of capital, like if you get into one ES contract and it goes against you by 10 points, which is not a big move, that would be $500. You're like, bro, that's a lot of risk. Okay, so how did you lessen your risk? Because you can't take less than one contract, right? You would go ahead and go into a micro, which would be like an MES. So in that same scenario, you take one contract, it goes against you by 10 points, which is not a lot. You'd only lose $50 versus $500. So how do you manage your risk better trading futures with smaller amounts of capital in the beginning, not to risk, say, $500 on a trade? Don't trade the normal contracts. Don't trade ES. Don't trade NQ. Don't trade CL. Don't trade GC. Trade the micros because your risk per contract is 1/10 the size. So it's important to know these things because you got to know the ticker to where you can calculate risk reward, right? And every single ticker is going to have a different risk per point per contract. And again, going the micros is simply going to allow you to take smaller risks. And it's a really good way to get your feet wet with futures as a beginner, with being able to really focus on risk management versus blowing up accounts. Okay. Now we're going to dive into platforms and then different types of demo accounts. And I recommend that every brand new trader at least get set up with one of these free trials with one of these platforms and open the demo account and start to practice trading futures on a free trial demo account. It definitely doesn't hurt. And you get about 2 weeks to do that. So platforms are going to be tools, right, to place trades, analyze the market. So that's where you're going to buy. That's where you're going to sell. That's where you're going to do your charting. That's going to be your broker and your platform, okay? And then you can set up a demo account that's going to let you practice trading without risking real money. And so before you even fund your first live account, you absolutely need to get into a demo, practice, make mistakes, learn, and then risk fake money. Don't risk real money, okay? The best platforms, to use for futures trading. My best part of this lesson. You got Tradeovate. That's probably the most popular one that traders start off with is going to be Tradeovate. It's user-friendly. It's great for beginners. You can trade on your phone as well. That's a nice thing. They don't have an app. You can actually go to a web browser, go to Tradeovate, log in, trade on your phone, which is nice. And they give you a 2-week free trial to get real-time data, to get into the paper account, the demo account, to just start practicing. Okay, but then you have Ninja Trader. Ninja Trader is very popular, but it's more for like experienced traders. There's a lot more advanced tools, functionality within the platform. You just can't use it on a phone. I don't think they have a phone app yet. I'm not sure. But I know when I was using it a couple of years ago, you had to use it on a desktop. And it's just really complex. There's a lot of tools, a lot of features and functionality. It's definitely more for experienced traders. would be NinjaTrader a good point in time, right? But it's really desktop focused. It's got really good charting features. They also do have a free trial. So if you want to sign up for a free trial, go to ninjatrader.com, set it up. But as beginner traders that are just getting started with futures, I recommend Tradeovate. Again, it's user-friendly. You can trade on a phone. You get the free trial. You get free data. And you don't have to pay for anything for the 2 weeks. Now, here's the cool thing. If you want an extra 2 weeks, what do? Sign up with a different email and get another 2 weeks. If you need more time than that, sign up with another email and do it again and get the time out of it through those 2-week free trials. Okay, so practice trading in real market conditions. You don't have to pay for the data. It's fully enabled. You get comfortable with the platform, with trading futures before funding your first live account, before you start taking real risk. And again, it's going to allow you to test the market, test setups and strategies without risking real money, guys. So definitely go to tradeovate.com. On their main page, there's a big button that says try a demo for 14 days and at least get started for 14 days. Okay, and those are going to be the brokers too. Right now, there's a lot of brokers. You can trade futures on Webull. You can trade futures on Schwab, Thinkorswim. But when I choose a broker, I want to make sure that the broker is the absolute best for what I'm trading. I don't think Thinkorswim and Schwab is the absolute best broker to trade futures on. I don't think Webull is the best, right, broker and platform to trade futures on. I would say Tradeovate is definitely up there, number one. Number two, NinjaTrader at the same time. So we all have different types of brokers depending on your style of trading and what you're trading that's going to be best fit for you. And the same thing applies with like equities, options, Forex, etc. You can trade futures on Webull and TOS. I just don't think it's the best platform and broker for futures traders. So again, the ones that I recommend, Tradeovate, number one, NinjaTrader. But let's also talk about prop firms, because you got everybody and their mom nowadays jumping on this prop firm bandwagon, right? Signing up for combine accounts, getting funded accounts, busting them, resetting that process, trying to get funded with real money. But there's a lot of prop firms out there. There's so many out there. And there's a lot of bad ones too, right? Like that one-of-one funding. If you guys heard the horror story with one-on-one funding, new prop firm, it was being promoted by a lot of these, stock market day trader influencers that have huge following, and they were just trying to make money through being an influencer, and they screwed everybody over. There were so many people that deserved payouts that met the requirements for a payout. They never got paid out. So they're investing all this money into combines. They're investing all this money into getting a funded account because there are fees associated with it. They're making money, right? They're meeting the rules. They're passing tier, and they're not getting paid out. And that happens all the time. So if you get set up with a prop firm, make sure it's a reputable prop firm. Make sure they've been around for a while, right? It may be a little bit more expensive, but at least you know they're not going to run out of liquidity. They're not going to go bankrupt. They're not going to shut down. And you're not going to risk making, say, 5-10 grand in a prop firm account and just losing all your money and never getting a payout. So make sure you pick and choose what prop firm you get set up with and choose a reputable prop firm. And so there's a big difference between a broker and a prop firm. A broker, you're going to set it up yourself. You're going to fund it with your own money, and you're going to risk your own capital. Okay? But with a prop firm, you're going to pay a few fees. They will fund you if you pass certain tiers and challenges, and then you get to trade their capital, and you don't have to risk your capital. So it's a way to get larger amounts of money to risk someone else's capital, not your own. And again, it gives you more access to more capital and more freedom, essentially. So big difference between brokers and prop firms, but same thing, gives you access to the futures market. And again, look at like their fees. Look at a prop firm's fees, even look at a broker fees, like NinjaTrader fees are slightly higher than Tradeovate, for example. So look at their fees, platform fees, data fees, account requirements, things of that nature. But again, if you're looking at different prop firms, just find one that's reputable. So there's 2 prop firms out there. One of them is like the absolute most reputable. So the first most reputable prop firm that's been around for a while, it's TopStep. TopStep is by far the best. They're an industry leader. They have structured evaluations. They have proven reliability. They've been around for a long time. TopStep is the absolute best. Then you have Apex Trader Funding. That's the second runner-up. They've been around for a while. They're reputable. I have students that use Apex. They're pretty flexible on their evaluation rules. They do their payouts pretty fast. They're trader-friendly terms and stuff like that, but I've just had bad luck with Apex. And I've seen the way that they treat their clientele. They don't treat them at a professional level. They talk down upon people. And I've just never really liked how they go about handling certain things within their organization. And as a business owner that runs a few different businesses, client satisfaction and how we treat others is super important to me. So the way that I see them handling things kind of just gave me a bad taste in my mouth. So I don't personally recommend Apex for those reasons. But there's a lot of people that have funded accounts with Apex. They like them. They get their payouts, all that good stuff. But I like Top Step. Top Step, I mean, it checks every box on my list as far as a good company. They've been around for a while. So I would go set up with, Top Step if you want to start the process of getting started with a prop firm. But I still recommend going to Tradeovate, signing up for that 2-week free trial, practice. And once you establish consistency, then think about opening up a Top Step Combine account, pass the Combine, get your funded, and at least have higher probabilities of getting payouts and making real money. So don't go start paying those prop firm fees until you practice first. Okay? And so again, go to topstep.com when you're ready. It's only $49 to sign up for a $50K account. If you pass that challenge account, you pay a $149 one-time activation fee to get what they call an express funded account. And that's going to be the account that they actually pay you real money on. Okay? So that's how to get started. Futures, tickers, brokers, platforms, the best of the best prop firms, just to kind of kickstart this journey. But let's dive into it a little bit more and talk about more trading related stuff, right? Account structure, different types of strategies, trade plans, and really help you bridge that gap. So now when you get into, say, the demo, you know how to structure your account, you know what types of different strategies work best, and at least you can kind of keep this momentum going. All right, so talk about account structure. Proper account structure is absolutely critical, right? It's the number one most important thing outside of mindset for, again, just long-term growth, to be a professional trader, to help you, again, manage your risk properly, to where you're not taking too much risk per trade and you put yourself in a position to bust your account. So we want to make sure that we structure your account to protect that capital, to optimize your returns. Even if with a prop firm risking their capital, you still need to structure your account. And the structure that the prop firm gives you is not the right structure you should roll with, right? The reason that they structure their accounts the way they do, because it makes it really easy for a trader to fail. Their business model is subscriptions. They want you to fail your prop firm accounts, because what are you going to do? Sign back up, try again, fail. Sign back up, try again, fail. Sign back up, try again, fail. And then boom, maybe you get lucky and you pass the Combine. Now you pay that $149 fee, you lose it. Just to go pay another $49, try and pass. And it's a process, right? I've done math on their business model, right? Based on the amount of clients they have signed up per month, based on how many funded traders they have. They make millions of dollars per month in subscriptions, but they're not paying out millions of dollars a month in trading profits. So they're basically betting on you failing. That is their business model. That's how they make money. They don't make money by their 90-10 trader split where you get 90% of the profits and they make 10. That's a little bit on the bottom line for traders that actually make money. But their business model to generate revenue is betting on traders failing. So if that's their business model, they're going to make sure that, again, they can generate revenue. So the structure that they give you makes it super, super easy for a trader to fail the accounts. So you have to restructure their structure on your own if you want to pass it, if you want to start getting payouts, okay? But let's go ahead and dive into just some key elements of how do we even structure an account in the first place. So it comes down to a few things. Number one, risk per trade. The golden rule of risk is 3%. You should never risk more than 3% of your account on a single trade. I like to go down to 1 to 2%. I still think 3% is a lot. I like 1 to 2%. And I personally like even sometimes structuring accounts to go below 1% risk per trade, depending on the type of setup that I see. So again, for example, if you're on a $10,000 account, let's just say your account's 10 grand, and you're risking that 1 to 2% of your account per trade, that means your per trade risk should not exceed $100 to $200. You shouldn't be risking $500 on a 10K account. You shouldn't put on $1,000 risk on one trade if you got a $10,000 account. That's way too much risk. Again, the golden rule is 3%, but take it back a notch. Go 1 to 2% and really set yourself up for success. And so why does that matter? That's going to help you get positioned, right? Match your trade size, how many contracts, to, again, what your risk tolerance is. And that's when it comes down to picking and choosing the right contracts. So let's say this example that you're going to risk 1%. That's $100 on a $10,000 account. And let's say that you went and took 2 ES contracts. And the thing went against you by 10 points out of nowhere, which 10 points is not a lot. You've lost like $1,000. You just lost $1,000. Well, that's 10 times more than you're allowed to risk. So you can't take 2 ES contracts if your risk is $100. You need to match your trade size, your positioning, to your risk tolerance levels so you can pick and choose the right contract to trade. So in that scenario, you would take 1 MES contract. If you took 1 MES contract on that trade and it went against you by 10 points, you lost $50. That's below your 100. If you took 2 MES contracts and it went against you by 10 points, that's $100. That's within your risk parameters. You couldn't take 1 or 2 ES contracts. You could only take 1 or 2 MES contracts. So understand what your risk is. That's going to help you match your trade size to your risk tolerance levels that you already predetermined, that you assess. And then that's going to help you pick and choose the right contract to trade. Is it a full contract? Is it a mini? And then everybody should have daily loss limits, right? At what point do you walk away? At what point is the market not working with you today? You got to know when to walk, right? Most traders don't know when to walk, and that's when they blow up accounts. When do you walk away? Set a hard stop for how much you're willing to lose in a single day. I like to do trades. So if I have 3 red trades in a row, I'm done, right? That's how I like to do it. I don't like dollar amounts. I like 3 red trades in a row because it's really hard for me to hit 3 red trades in a row. And if I do, I'm off. Maybe I'm not mentally dialed in. Maybe the market sucks. That's when I walk away. So if my max risk per trade is 1% and I have 3 red trades in a row and that's my max walk away, I only lose 3% of my account on the day. 1 green trade wipes out my 3 losers. So that's how I like to set my daily loss limit. Not a dollar amount of how much I'm willing to risk dollar amount wise, but how many trades in a row. Is it 3 trades? Is it 2 for you? Choose which one works best. I like 3. And then walk away if you hit that limit. Protect your capital. Live to trade another day. All right? The last thing you want to do is overtrade, revenge trade, get greedy, and now you're down 10%. If you're down 10%, it's going to take you 3 green trades to barely break even and recover that, right? So don't risk that much. Set it at 1% per trade, 3 trades in a row of losses. You walk away, that's 3%. 1 winning trade wipes that claim. So it's a lot easier to recover with 1 great trade. And then, again, scaling up, when you guys want to scale up, don't try and scale up from 1 MES contract or 1 MNQ contract and try to go to a full-size ESNQ. That's silly. That's a 10x increase in risk. So going from 1 MES, then scaling up to 1 ES, that's 10x. That's way too quick on scaling up. Scale up little by little by little. So go from 1 MES, for example, to 2, from 2 to 3, 3 to 4, all the way up to 10, for example. And then think about going to 1 full-size ES, NQ, whatever the case is, but slowly scale on up as you build a buffer in your account, as you make money, as you have more drawdown potential. Then you could slowly start to scale up, increase your risk a little bit, which again, help you increase your reward. So scale up slow. Don't go all in. Don't force it. Take it at a nice, slow, healthy pace. And that's going to be the best thing that works for you guys when it comes to scaling up to make more money. Okay. Now let's talk about, again, restructuring the prop firm structure. That's what we talked about. If you just follow the structure they give you, you're going to bust the account like a day. 100%, right? They don't give you a max daily drawdown limit. They let you take 5 full-size contracts on a trade with only $2,000 of drawdown. You take 5 NQ contracts on a trade, it goes against you by 10, 20 points, you've busted. They make it easy for you to bust those accounts because they want you to sign back up. That's how they make millions of dollars a month. So restructure their structure. Okay, restructure it. So let's go ahead and break it down on a top step 50K example. Okay, so here's some account limits to note. You have a 2K drawdown on that 50K account. That's the total loss allowed before you fail the account, and it does trail as well. So if you start with 50K and you go up to 52K, right, now you can't go back below 50K, right? So it does trail. So when you start day one with no profit loss at a 50K account, you could technically go down the $48,000, that $2,000, before you fail the account. But if you make $2,000 in profit, right, and then you go back below, say, 50K, you're going to bust the account because that $2,000 will trail up to 50K, and then that's where it stops trailing, right? So just be mindful of the initial $2,000 drawdown. That's the total loss before you fail it, but that will trail up as you make profit to that $50,000 area, and you can't go back below that, or again, you will fail the account. And these are the types of risk parameters that I teach my students that learn futures, that start trading futures day one. These are the risk parameters. They'll let you lose $1,000 in a trade. They'll let you lose $1,000 in a day. They'll let you bust your account in a day. That's stupid. So restructure their structure. Your max loss per trade should be $125. Max day one to start. $125 per trade max. That obviously keeps you really safe within that $2,000 drawdown. Okay? Now, as far as targets, like, okay, what kind of targets? You should be targeting like 2-to-1 minimum risk reward, ideally 3-to-1 minimum risk reward. So with the right entries, you always get the best of the best, tightest stops. It's going to be easy to bang out 2-to-1s, 3-to-1s, 2-to-1s, 3-to-1s. Those are your base hits, right? Focus on base hit, base hit, base hit. Don't focus on home runs. You're not trying to pass this in a day. But if you can stay consistent with base hits, you'll pass it in like 6-7 days. So max loss per trade should not be more than 125 in the beginning on a new prop firm account. It's going to keep you super safe within the 2K drawdown limit. And then target setups, at least 2-to-1, 3-to-1 setups. So your example, $125 of max risk per trade with the potential to make $250 to $375 per trade. That's a really good day. That's a good trade. Risk 125 to make 375. You do that 2 times, you've made over $500. You do that for 5-6 more days, you've just passed your combine account, and now you're trading with 50K of funded capital, and you get paid out on that money. Okay? We already talked about your daily loss limit. If you have 2 to 3 red trades in a row that are losses, that's when you should walk away. So what would that be if you had 2 red trades back to back, right? You would lose $250 on the day. It's going to take you 8 days of just losing. 8 days, right? Before you bust your account. You would have to have 15, right? 15 red trades in a row before you bust your account. It's going to be really fucking hard, excuse my language, really hard to lose 15 trades in a row at 125 loss, 125 loss, 125 loss. It's going to be rare. That's why we structure it this way, because it's dang near impossible, right? To have 15 red trades in a row. Now, if you don't know what you're doing and you just go into this right now, right here, you probably definitely hit that 15. You start in the demo for a couple weeks, you gain the skill set, you learn through some trial and error, you get consistent. It's going to be hard to have 15 red trades in a row. It's going to be hard, right, to have 8 red days in a row. So I like the daily loss limit of 2. If you want to go to 3, that's your walkaway point. It ensures you stay disciplined, you protect your capital, and you set yourself up for success, because it's rare you're going to have that many red trades back to back to back to back to back to back. So you're putting yourself in the best possible position to not lose the account, to pass it, to get funded, to make money. That's what you guys want to do, make money. The numbers protect you, right? You would need 15 consecutive losing trades to fail that account. And it's really unlikely if you just follow proper risk management and stick to high probability setups where you're banging out those consistent 2-to-1, 3-to-1 setups, and you're not risking more than $125 per trade. So let's do a quick little example, right? Let's say you're trading MES, that's $5 per point, okay? And let's say you took 1 contract. How many points could you risk? You could risk like, what would that be? 12 points? 12 points of risk times $5 per point is 60. times 2, that's 120. So you could technically take one MES contract and it's $5 point risk. You could lose, what was that? 24 points on the trade? That's a lot of risk. 24 points on a trade. That's wild. You're not going to take trades where you have 24 points of risk. Maybe, I don't know, 10 points of risk. So if you do that, you could take how many? 2 contracts at 5. So that's going to be $10 a point on 2 contracts, right? So $10 a point on 2 contracts. And then that would be 12 points of risk. So if you have a trade that you're like, okay, my risk is 10 points, my reward is 30 points, you could take 2 MES contracts to not lose more than 120 bucks, right? And your max risk is what? 125. So that's how you would go ahead and build the plan to get positioned. Where's my entry? Where's my stop? How many points? 10 points. 2 MES contracts would be $120 of risk. That's within my 125, but you put yourself in a position to make $375 plus on that trade. So that's how you're going to go through and basically plan things out, get structured, get positioned per trade. Now that you know how many contracts you could take, what the per point value is, and what your max risk per trade should be. Okay? All right, let's go ahead and move on. And again, I am recording this. I do have this entire breakdown. I can send both of these to you guys to make sure that you can pick up where you left off. If you have questions, we'll answer those here in a moment. But again, high-level overview. High-level, quick, fast overview. Get you guys up and running. Okay? Want to talk really quick about a few different trading strategies that work well for me. Right, that work well for me. So a couple key takeaways. Simplicity is key. If this is your first time being here, I like to keep things simple, but really effective. I like to keep it so simple that an 8th grader can understand this. No jargon, no fluff, no BS. If you've been here for a while, you know that my approach is super simple, very effective. 70% of the time, right? My analysis is spot on. The trades work. They're profitable. And again, it's a very simple approach. We're not using all the fancy indicators. We're not using all the fancy BS. It's literally just high probability setups. Simple, high probability setups, okay? 2 strategies that work best for me in the futures market is I like to scalp off 5-minute order blocks, okay? And I like to also trade off key daily zones of support resistance. So go to a higher time frame, find all of your key, most significant daily zones, let the stock get to one of those key daily zones, get good at reading price action, and then trade off those zones accordingly. You always get the best entries with the least amount of risk and the highest amount of reward. It's a no-brainer, simple way to trade, and it's effective. And then scalping off 5-minute order blocks, okay, is like one of my go-tos. So identify order blocks on a 5-minute time frame. Look for price to revisit that order block. You're going to enter near the middle or the top or the middle or the bottom, depending on what type of order block it is, right? If it's going to be a bearish order block, you're going to enter near the middle or the top of the bearish order block. You expect price to fall. You're going to short that. If it's going to be a bullish order block, right, and you're looking to get long, you want to get in right at the middle or near the bottom of that bullish order block because you're expecting price to react to the upside out of it. So that's where you're going to get those fine-tuned, dialed-in entries on those 5-minute order blocks. And risk-reward simple. You're going to put your stop loss just right below or right above the order block, and you're going to set a standard 2-to-1, 3-to-1 risk-reward. That's it. You're not going to overanalyze it in the beginning. You're not over going to think it. You're not going to try and catch 1,000 points to the upside or the downside and aim for the prior swing highs and swing lows, right? You're going to see more losing trades than winning trades if you do that. So identify 5-minute order blocks. Really hone in your ability to nail entries in those 5-minute order blocks. Stops go just right above or right below. So stops are always really, really tight, right? And then lastly, just set a standard 2-to-1 or a standard 3-to-1 risk-reward ratio. Okay? And when you hit that quick 2-to-1, 3-to-1, take profit, let the base hits add up. Okay? And so here's a couple quick examples of order blocks, right? So here's a little bit of a 5-minute order block, okay? You're going to go ahead and mark up the order block. That's a bearish order block. You're going to wait for price to return to the order block. Your entries are, again, in the middle or near the top of the order block, ideally. The top 50% of that block are where the best of the best of the best entries are going to be. Stops go right above it, and then set a standard 3-to-1, 4-to-1, whatever risk reward. Take your profits when targets hit. Okay? That would be a bearish order block. Okay? A bullish order block. Where did my thingy go? Oh, no. Let me load that back up. One sec, guys. I just hit the X button. There we go. Right, and this is going to be a bullish order block. So we have this little 5-minute bullish order block. So again, you're going to be looking to get in at the bottom 50% of that order block. So in the middle or near the bottom 50% of that 5-minute order block. You're going to put stops right below the order block, and you're going to set a standard 2-to-1, 3-to-1 risk reward. If you hit target, you take profit, you walk away. This is a very high probability way of trading, right? 60, 70% win rate. So if you have a 60 to 70% win rate and you're consistently banging out 3-to-1 setups, you are extremely profitable. You are very profitable. And it's it. 5-minute time frame, 5-minute order block. Dial in the entries, low risk, good reward, 3-to-1 setups, consistently, 60% win rate. You're making money. 50% win rate. You are still making a lot of money. So you could be wrong half the time and be right half the time. Consistent 3-to-1 setups, boom, you're profitable. You're making money. And it's one thing. It's find the order block, wait for price to come to the order block, dial in your entries, set risk reward, see what happens. You're going to notice 60, 70+% of the time, you get those quick 2-to-1, 3-to-1s out of those order blocks. No indicators, no fancy stuff, simplicity. Simple but effective. Simple but effective, high probability setups. Okay? And then I like to trade off key daily zones of support resistance. So what I'm going to do, if you guys want how I find key daily zones of support resistance, follow up with me after the training. I will give you a lesson on how to find key daily zones of support and resistance. I'll give you a free training on that so you can find the key zones. And I break down my process of how I trade off those key zones. And so that's going to help you guys out without diving too much into it here, because we're going to go ahead and start wrapping this up. Lastly, we're going to talk about those simple trade plans, right? Which you guys already have an idea of the plans. So trade plan, it's your roadmap for every trade you take. It's going to help you stay disciplined, right? It's going to help you eliminate emotional decisions. So here are the main components of a solid A+ trade plan. Set your entry criteria. We just talked about that. The bottom or the top 50% of the order block, for example, that's your entry criteria. Determine your exit points, stop losses, and targets. We talked about that. Stops right below or right above an order block with a standard 3-to-1 risk reward. Those are your exit points for stop losses, for targets. Then, what's your per trade risk? Remember, it's 125. So go ahead and map out how much risk do I have. 10 points. Okay. 2 MES contracts. I say 10 points of risk. I'm losing 120. So that's how you go ahead and get position on that trade, right? And you know what your risk is going to be before you take it. Okay. Define the trade size. That example would be 2 contracts. Some trades it could be 3 contracts. Some trades it could be 5. It depends on how much risk on the chart, right? Could be 5 points of risk, 10 points of risk, 20 points of risk. Based on that risk you have on that trade, you know how many contracts to take and what contract to take. And again, standard 3-to-1 risk reward. Don't set targets based on the chart just yet. Just quick 3-to-1 setups and just bang those base hits out consistently, make money, keeps it super, super simple. And then you know when to walk away. 3 red trades in a row, you're done. You walk away, live the trade another day, come back tomorrow, and see if the market gives you better opportunity. Okay, it's going to keep you focused on high probability setups. Those are the 2 most simple, highest probability ways of trading without the overly complex BS. Okay, simple but effective. Removes the guesswork. You know what to do. 5-minute order block. You know how to enter. You know how to build a plan. You know how to get position. There's no more guesswork. There's no more emotions. You're clear. You're laser focused. It makes sense. It's going to help you stay consistent and even make sure that if you have a 40% win rate, 50% win rate, you're still making money. You're still profitable, and you can be wrong more times than you're right. It's going to help you stay consistent even during some losing streaks. All right? And then lastly, key thing, guys, key thing. You're trading for a reason. You're entrepreneurs. You have an entrepreneurial spirit. You want to trade for money now. You want to trade for generational wealth, leverage your day trading skill set, manage long-term accounts, set yourself up for millions during your retirement, create a legacy, build generational wealth, pass it down to your kids, right? you have an entrepreneurial spirit. This is a business, right? This is a business. So you got to start treating trading like a fucking business. Excuse my language. But so many traders do not operate trading like a business. No wonder they freaking fail. 95, 99% of traders fail, right? For a lot of reasons. They don't ever understand how to, manage risk, right? They don't get their mindset right. The biggest thing too, though, is they don't treat trading like a business. You need to treat it like a business. What do businesses do? They collect data, they analyze data, and they make data-driven decisions. Before they make any decision within their organization, their decisions are backed by data, right? Coca-Cola, still to this day, spends millions of dollars in ad spend. You see commercials all the time. They're fucking Coca-Cola. Everybody knows about Coca-Cola. Why do they keep spending millions and millions of dollars a quarter on advertisement? Because they looked at the data. When we don't spend money in ads, we don't make the revenue. When we spend money in ads, we get 10x the revenue. So, okay, based on the data that we collected and analyzed, we can make a decision to keep putting millions and millions and millions of dollars a quarter into advertisements because clearly it makes us more money. There is a return on that investment, right? So again, treat it like a fucking business, guys, right? Quit playing games. It's not a game. You want to make money? You want to take it serious? You want to change your life? Treat it serious, okay? It's not a hobby. It's a business. Treat it like a business. So collect data, review data, and make data-driven decisions. So log your trades. That's how you collect data. Log your trades, track in progress. It's going to help you improve over time. And you need to have that detailed trade log. It's going to help you identify your strengths, what's working, your weaknesses, what's not working, and any kind of trends, patterns, right? Maybe the nights that you don't sleep good, you lose a lot of money. Well, shit, quit trading if you don't get good sleep the night before. Just collect the trading data, analyze the data. You're going to notice your strengths, your weaknesses, what to double down on, what to stop doing, any kind of routine, any kind of trend that you notice. It's going to help you make decisions to move forward to become a better trader. All right. So basic trade details, your ticker symbol, entry price, exit price, position size. That's simple. Anybody can do that. Right. What's your profit or loss in dollars or points? Keep track of that. What's your average risk to reward ratio on the trade? Keep track of that. But the biggest thing, the two biggest things that traders don't do when logging trades is they don't notate the reason for the trade. Why did you get in? What was the strategy? What was the setup? And the next biggest thing is their mindset behind the trade, right? How were you mentally? Were you dialed in? Were you disciplined? Or were you trading with emotions? No one ever actually journals. They collect data, they log their trades, but they don't journal the trade. Was I revenge trading? Did I just have a bad losing trade and so I was just trying to make that loss back? Right? Did I not sleep good the night before? Did my wife yell at me last night so I came in pissed off? Right? Was I mad? What was your emotional state before taking the trade, during the trade, after the trade? Right? Notate that. That's key data as well. How did you feel during the trade? Did you feel confident? But then did you get nervous when the stock started to pull back so you freaked out and got out? Journal everything about the trade and put notes in there. What went good? What mistakes did you make? What could you do different next time to see better results? Be as detailed and be as thorough as possible. Like I said, you're going to spot trends in your successes and your failures. You're going to know what to go all in with and what to stop doing. You're going to identify and fix mistakes, emotional decisions, poor entries, poor exits, whatever the case is. And that overall is going to help you build confidence, right? By tracking your progress over time. And let's be real. The more confident you are in something, the better you do at it. If you have done anything in life where you're not confident, usually you kind of suck. But the more you do it, the more confident you become. The more confident you are, the better you do that. So the more confident you become with your trading, the better trader you will become. It's just a byproduct, okay? And so I like TradeZella. All right, go to tradezella.com. It's a really nice online interactive trade log system. It's awesome. You can import your trades, right? It collects all the data for you. You got a little notate section. It's a really cool system. It's a very cool system. And there's a lot out there. You have like TraderView, TraderSync, all kinds of different, trade log systems. I would say TradeZella is by far the best. So go set up an account with TradeZella, okay? And then even log your demo trades. When you go to TradeAvate, and you sign up for that 2-week trial and you start to practice all these things and implement these things, start collecting data now, right? Collect data now. Get into a habit of doing that, okay? Review the data, analyze the data, make data-driven decisions. I would even go ahead and do this now in tandem with setting up a futures account for a demo to get your feet wet, all right? And so, like I said, breaking it down so an 8th grader can understand this. No fluff, no BS, no jargon, no technical anything, right? Just straight to the point. Help you guys get up and running with futures 10 times faster. This is what you need to know as far as what's the difference between futures and options, right? Different types of tickers, risk reward per point. That makes sense. Best platforms and demo accounts to set up with, the best brokers and prop firms to get going with, how to structure your account and how to restructure, right, the structure of a prop firm account, the best 2 strategies to learn that work best for futures trading, in my opinion, right, how to build trade plans and why we log trades. If you just focus on those steps, you learn these things even further, you dial these things in even further, you start to implement these things on top of everything else that we'll support you guys with, additional trainings and whatnot. Again, a couple of weeks, you'll be up and running with futures, and you'll do far better than 95% of futures traders do. They don't have any kind of structure. They don't have any kind of system. They don't really have any kind of guidance. All right, so let's go ahead and open up the floor for some Q&A, guys. All right, let's go ahead and do some Q&A. Questions that you guys have. Let's dive into it. Make sure we bridge the gap. All right, Q&A open. Ask away. Fire away, ladies and gentlemen. I know we talked about a lot. There was a lot here. Okay, so if there's something that doesn't click or make sense, let's talk about it. Does Tradeovate charge per trade? There's going to be commissions and fees per trade. Yes. You go to tradeovate.com, look up their fees. They have different kinds of fees. Every broker is going to have a different fee. So you just got to go to tradeovate.com and look at what their fee structure is, and you'll know what the fee structure is per trade, per contract that you take. So yes, they will charge you commissions and fees per trade. Yes. Absolutely. If you want this recording, go join the free community. Link is in my profile on TikTok. It's a Linktree link. Go click it, sign up for the free community. And what I'll be doing is I'll be editing this, and I'll be sending the resources to people in the free community. All right, so this guide that we were going through, I'll send that with the recording to the video, so you guys can go back, rewatch it, and start taking these steps, guys. When I'm talking stocks, it's crazy. When I talk stocks, we get like 100 viewers. When I educate people, no one cares. So for the ones that stuck around, for the ones that are here, awesome, right? There's some gold nuggets here, right? Even if you took one little thing away, that's a gold nugget. You can apply it. You can run with it, right? You can take that next step, learn how to trade, become better, get into the free community, learn how to find those key zones, learn how to read price action, learn how to find order blocks, right? Actually take the next step. But it's crazy when I do free trainings or lessons, no one cares. They just want the get-rich-quick answer. They want it now. They're not willing to put in the work. So I respect the 41 of you that stuck around. Pay attention. They're going to follow up with some questions. You're the real ones that actually want to succeed with this, and that's awesome. There's a unique methodology to identifying order blocks. So that is one of the lessons that I don't give away for free on order blocks, but you can go to YouTube and figure it out and learn how to find order blocks. It might be complex. They may use all the jargon. I don't use the jargon. I don't fluff shit. It's no BS approach. But that's one of the things that I do teach my students, but it's not one of the free lessons that we have right now. But the key zones of support resistance, right? The key zone support resistance, that free training is in the free community. So it's super easy, guys. If you just literally go to my TikTok page, right, my profile where we have 102,000 followers, and click the link tree, okay? and you click where it says join my free community and you scroll down, you can just join the free community. And then once you're inside of the free community and you go over to the free education tab, there's so many free lessons. 6 lessons from our course material, a lesson on fib retracements, 10 steps to become a profitable trader in 2025, how to structure your account, create risk parameters, how to build plans on options, right? How I find my key zones of daily support resistance to trade off of. There's a lot of free resources here, tons of A+ education. And the other thing, too, is you get to tap into the community. So if you have questions, we can support you, we can help you, and it's free, guys. So if you want to learn how to find the zones, read price action, mindset-related tradings as well, this is where you guys want to be. Absolutely. And that's where I'm going to be reposting this as well. So I'll post this on up in there, the video recap link with this breakdown as well. So you have access to this, what you see. And dude, there's some gold nuggets in here for you guys. Uh, 12 months minimum of expenses. So if you like $5,000 a month pays the bills and lets you live comfortably, it's $5,000 a month. You need to have 60 grand aside before you think about trading full time. I would say at least 1 year of income where you can live comfortably. You got a lot out of that, so definitely appreciate it. Yeah. And like I said, it's a high level overview for getting started. We didn't get into the weeds. There's a lot more to learn, but you got to have a foundation first. This is your foundation. Now you have a foundation. You can start taking some steps forward. Then learn more. There's so much more to learn. But without the first step, where are you going? What are you doing? You're going to go about it the wrong way. This is going to help you take the right steps in the right direction, solid foundation, move the needle forward, and start to implement some of these things.